So, hello, hope everybody's having a great day. Here we go. Another one of these Substack videos. No trade calls, no recommendations, or responsible loan stuff. We're here for educational purpose only. I was going to do a video on Euro, but decided to just do DXY. It's just hopefully helpful to most people. And anyways, Euro is the biggest driver of DXY anyway. So you just flip the chart the opposite way around and you've pretty much got the Euro USD chart. Here, we've been looking at these $3 ranges in DXY, and as we can see is we've been hovering around this basically 197 mark essentially since April, May of last year. Now if you look at the bigger picture view, and I think the easiest way to look at it, then not even on the monthly, is well, I mean, you can look at it on the monthly. Let's go through all the time frames. On the monthly, you can see that here, this is a really critical location, right? Not only because of a couple of different technical references, but also on the monthly timeframes. You've got big series of higher lows that market is trying to hold. Again, trend lines are tricky because people will be drawing them, in a lot of different ways. But you get the gist that we're still holding this series of higher lows. But on the other hand, what's happening is, this downside is accelerating. So this is trading very, very heavy. So usually what, some people would call this some kind of an H pattern. So what that means is either we break down and then this gets extremely heavy, or usually when you get these kind of bounces, it rips back through even the 50% back of the move from A to B. But clearly you can see these are all the fib extension targets to the downside of this current A to B move. And you see 95, 91, 79, 90, 35, and you see that broadly speaking, this whole area aligns with the 200-month moving average. So there's an awful lot of confluence there. So I think if you see a breakdown below recent lows, what you would be looking at is really high odds that the market, especially on monthly closes below this this previous low, that the market is going to try and come and unwind all the way back into the 9170s, 9035s, back into these previous lows. Now on the weekly, and this is something we're discussing not only on Substack but on Twitter too, last week I said, once we're starting to base here, we said, watch out, you're also going into month-end flows. You'd expect the back end of the week to be sideways to up. And indeed, that's what we got. Now, remember, when you get this kind of pure reversal at a key reference point, it's extremely rare for it not to try and accelerate to the upside. And this goes both to, failures at highs or reversals at lows. When you see these kind of candles, it's very rare that you don't get some follow through. So here, your base case assumption when you see this is that the market's going to try and come back into this 10-week moving average, back into the 2026 open. Now, it doesn't mean everything shifted. It's just a little bit of a healthy rotation inside the range. And broadly speaking, this is a range that you can see not only in Euro, but also on SPX, right? So let's flip it the other way around. Now, this is the SPX chart we've been looking, and broadly speaking, you can see that here too, we're kind of hovering in this range, desperately looking for direction. So here, shorter term on DXY, what you should keep an eye out for is don't get confused by velocity of move inside this range, because it really doesn't mean much. Now, again, below this level, weekly, monthly closes below the 95, very high odds that we try and print back into those downside targets. Here, if we get daily, weekly, monthly closes above 100, then fairly high odds that we try and retrace, back into the 50 back, as we said higher, of this move from A to B, which is at the 103. And remember, because the market essentially printed, A to B, we come back down, failed, chances are on a break above the 100, this is not going to be a shortable level. Chances are on a break above, this is going to rip up and tag this 61.8, so possibly all the way back into the top end of the range, back into the 106. So right here, again, and on it's the same thing as Euro, right? As it was hovering here, need a little bit of mental gymnastics here, is the case could have been made, right? And Euro is the opposite, right? Could have been made for one, sideways range, 2, that it was trying to form a head and shoulders, you see inverse head and shoulders here that broke, or 3, that it was trying to break down, to break up. So here again, all 3 options are still open as long as we continue to trade inside 100, 107. Now, below, risk those monthly targets. Above, first target would be 103. And especially if you get that into with an aggressive move on a real catalyst, you would not expect the 50 back to hold. You would expect it all the way back into 106. But the main message is, remember, kind of like we're seeing on equities here, a lot of stuff is stuck inside choppy ranges. Do not get confused by velocity of move inside range. Even here, you see the market tried to break down, it couldn't, tried to break down, it couldn't, tried to break down even more, right? Catching everybody off guard when everybody's short dollar, and it can't. So the key message here is that there's so much uncertainty, there's so much headline risk that the market really needs a proper catalyst. Don't get fooled trying to chase a breakup or a breakdown on no real catalyst, on no real volume, because chances are we continue to be stuck until something substantial changes. Okay. Hope this was useful. Wishing everybody an awesome day ahead. All the best. Talk to you guys soon. Take care. Bye-bye.